Hi friends, welcome back. So headline, the S&P 500's golden decade of returns is over. And this is coming from Goldman Sachs. Basically, they're going to make a prediction on what they think is going to happen in the S&P 500, right, the American market, in the next 10 years. And I want to go over this because I think it's an important one. I'll share my thoughts and I want to get yours as well. So let's check this out. It says here, the stock market's decade-long golden age will soon be a thing of the past. Again, this is coming from Goldman Sachs, just came out today. A new report from the firm's portfolio strategy, a research team forecast that the S&P 500 would see an annualized nominal return of 3% over the next 10 years. So not a great return. Again, an annualized nominal return of 3% over the next 10 years is coming from Goldman Sachs. That would put it in the 7th percentile of performance since 1930. So we're in the year 2024 and then 2025. So almost 100 years of stock market. They're saying that they think the next decade is going to be quite low in comparison to prior performance in the market. Now, do be aware it's hard to predict what's going to happen in the next 10 years, but I do want to read through this stuff because I think it's important. Moreover, again, 7th percentile compared to the past performance. It says it would also badly lag the 13% annualized figure put up by the benchmark index over the prior decade. Again, this is coming from Goldman Sachs. So we're looking at 3% the next 10 years according to them. This is important to cover also because, as we talked several times on the channel, for most people, you're better off just getting the S&P 500, like some sort of index fund, something like that, if you can enter the market. Warren Buffett says the same kind of thing. Then you don't have to be stressing out, am I in the right sector, wrong sector, etc. It doesn't mean that is your exclusive strategy. This is a good way to build a base on your investing. And this is also, too, why we're going over this, is just sort of have some sort of realistic foundation of what we're talking about here. Quote, it says, investors should be prepared for equity returns during the next decade that are towards the lower end of their typical performance distribution relative to bonds and inflation. I think bonds, I think they're around 4% right now. There's one prediction that they could go up to 5% in the next 6 months. I just saw that come out today, but again, it's hard to predict exactly where stuff is. But essentially, if you're looking at, hey, it's going to be 3% in the S&P, and if bonds are 4%, bonds start looking pretty attractive. But things start balancing out, right? If more people move into one, the next sort of weakens the other one. And remember, it's buy low, sell high, etc. So again, this is hard to predict the next decade, but I want to see what they have to say, and I want to get your thoughts. As an extension of this forecast, Goldman sees stocks struggling to outperform other assets over the next 10 years, and we just talked about that. By its calculation, this is interesting, by its calculation, the S&P 500 has about a 72% chance of trailing bonds. Wow. And a 33 probability of lagging inflation through 2034. So they're saying the S&P 500 could, be behind inflation, right? So not even perform what inflation is going to be and be behind bonds. Interesting. So it looks like they may be pushing bonds a bit here. 5 factors underlying Goldman's lackluster outlook. So again, we're looking at 5 things. What are they saying? First, a historically stretched stock market valuation implies lower future returns. Yeah, so the way that we're valuing our stocks, it seems to be a bit out of whack. P/E ratios are too high. And it doesn't necessarily mean the market's going to crash. It's just that we may not necessarily have crazy growth from here because how much longer can you grow? And if you don't understand, it's essentially how are we pricing stocks to compare to how much money that they make, essentially how much companies, it's price to earnings, right? Current valuations are indeed elevated with the cyclically adjusted price to earnings ratio at 38 times or in the 97th percentile. So this is sort of, how much higher can they possibly go? The S&P 500's CAPE ratio has averaged 22%. What are we looking at here? So I think there's a chart they provide. And we've actually, if you want to look at it, you can Google the Shiller PE ratio. Essentially what this is a slightly different version of it, but it's basically the same thing. It'll give you the numbers here. So we're at 38 times earnings. We're talking about the market. This should be adjusted for inflation. And the last time that we peaked would be like the COVID bubble, and then also to the dot-com bubble. I can see it on the chart here. So we're trading pretty high. I always say this all the time when you see these numbers like the market ratio at the PE ratio being at 40, it's probably time to get out. And it's hard to compare exactly every decade, but I'll just say in today's market, in today's world, more and more people are invested in the market, right? Be it through your 401ks, etc., or it's easier to open up brokerages accounts. Just like it's a different world, but it doesn't necessarily mean you ignore the past. Because I understand for some people who are just getting the market recently, you think, oh, this is normal that I get 13% a year or whatever, or your crazy crypto coins, which in my opinion is the tulips of this decade or this century, I guess you could say. That's not necessarily normal. Second, market concentration is near its highest level in 100 years, Goldman says. Wow. So basically, we're talking about the Meg 7 stocks, right? Your tech stocks, like they're getting all the gains, all the AI hype, crypto hype, etc. So I didn't realize this. I knew that we had a problem of being overweight just a few companies, but highest in 100 years. Wow. When equity market concentration is high, performance of the aggregate index is strongly dictated by the prospect of a few stocks, right? We know this. It's and it's actually, I keep some reports where like Nvidia is like most of our gains in the market. So it's kind of crazy. Even today, Nvidia was up and everything else was down. It was kind of nuts. And actually, I can show you that. This is just today. Like, see, Nvidia's at 4%, and look at all the red in the market. Like, it's not a healthy market. I mean, there's that. Let's see here. Let's go back to where we were right here. These stocks include tech large caps such as Nvidia and Alphabet, whose performance has driven the S&P 500 more than 20% higher year to date, right? While that's led the index through a string of record highs this year, it fosters a market marred in volatility risk and a need of diversity. Yeah, we just have too much money in just too few of things. We had that like crazy carry trade crash from Japan, and it looked like a lot of people overseas were essentially leveraging into companies like Nvidia. It was like, well, I mean, that's the one that's going up. That's what everyone's doing. I'm going to borrow money and keep doing it. It's just unhealthy. Our historical analysis show that it is extremely difficult for any firm to maintain high levels of sales growth and profit margins over sustained periods of time. The same issue plagues a highly concentrated index, right? And, be it we talk about, say, Tesla a lot on this channel, or you can mention NVIDIA, when things are going great, it seems like, oh my God, they have this, mode. No one else could ever make cars, talking about Tesla, like they're the only company in the world. And that's kind of, people think that way, but it's just not the way that it works. Like it's only so long that you can, dominate a particular sector of the market. Other companies start to catch up, right? Also, your sales growth can't be crazy forever. For example, if you make one car the first year, the next year you make two cars, and like, oh my God, I doubled. And the next year you make four cars, oh my God, you doubled, right? But when you start to get to say like, going from 1 million to 2 million and then 2 million to 4 million, right? It's just hard to maintain crazy growth levels, or crazy growth rates, I should say. So, they're even saying here, yeah, it's just hard to maintain that. While some may find reason to argue why tech stocks will maintain growth momentum, and you'll find that a lot on YouTube, history suggests that revenue will slow. Goldman said the S&P 500 firms that had consistently generated over 20% revenue growth underwent a sharp drop off after 10 years. I see. So it just goes in cycles, right? I'll read this part again. Goldman said that S&P 500 firms that had consistently generated over 20% revenue growth, talking about revenue growth here, underwent a sharp drop off after 10 years. So essentially you can grow for the first 10 years, I think it's or not first, but if you grow this kind of rate at 10 years and after that, then you may have a drop off. Now, it doesn't necessarily mean we have crazy crash. It just means not necessarily growth. I think Apple's a good example, right? So they've certainly had their run. There's nothing wrong with Apple. It's just that they're not going to grow at the same rate as before. I mean, once everyone buys an iPhone, how many more can you possibly sell, right? You run out of customers. And so that's why they're starting to sell you headsets and watches and maybe cars, but they cancel that. They're looking for other things. U.S. equity market concentration, 1925 to 2024. Okay. So this is looking at different periods in our stock market here. And a high indicator would mean essentially when you have a high concentration. It says weight of the top 10 stocks in the S&P 500. So when your top 10 stocks, it makes up a large part of your market. And this is where we are now. It's interesting. It said we were like in the 97th percentile. I mean, according to what I'm looking in the chart, it looks like at the very, very top of where we were. I guess the last time was 1932 when we had this kind of concentration. That would have been the crazy, Great Depression type of stuff here we're talking about, and the Great Crash. I don't want to, sound doomy and gloomy here, because I think we're in a different period than then. But I mean, just numbers speak for themselves. I'll leave it at that. And you guys want to go back and look at that chart, pause the video. But I'll say if they need any of this stuff, the best way to protect yourself is just diversify. Don't throw all your eggs in one basket, right? Don't go into leverage, and all in on Nvidia, now at these levels. I think that would be crazy. Certainly you'll hear about the stuff on the internet. Oh my God, I mortgaged my house 5 times, and that kind of stuff. And I got an Nvidia last year, and now I'm doing fantastic. But it's the kind of people that do that. Maybe they get some gains quickly. But those kind of people also lose very, very quickly. So, in all things, moderation, diversification, and understand what's going on. So, third, Goldman expects the economy to contract more frequently for the next decade. Oh, interesting. So, some contractions here. The firm said the US would see 4 GDP contractions over the period or in 10% of quarters. Okay. I see. So, for each quarter, I guess in the next decade, they expect 4 contractions. So it's not that often, but it can happen. Okay, but I guess it's more frequently than before. So generally speaking, the U.S. economy grows. So we're just talking about grow or not grow here, because there's not necessarily projections on how much it's going to grow overall, but you will see some contractions, which is more than normal, they say. That's up from 2 such instances during the previous decade. Okay, so essentially double the amount of contractions, but it's actually not that often. But again, this isn't necessarily rating the size of what they could be. And also just to remind you guys, this is over the next 10 years, so who knows? Goldman added that annualized equity returns typically average minus 10% during these periods of economic slowdown. Okay. So you could have up to 4 drawdowns is what they're saying in the next decade. I'm not sure how they would come up with that kind of thing. I guess this is their model here. And for those of you who are, math people, let me know your thoughts on this kind of thing. The other stuff I don't pretend to be like a math genius for this kind of stuff for for forecasting the next decade. I can read this stuff, but I'm not quite sure how they come up with this one. Let's just see what this says here. Frequency of economic contraction in the rolling 40 quarter period. So that's 10 years since 1950. Okay. So they're looking at other periods of time from 2024 to 2034. So that's kind of in the middle. Looks like we had a bunch of contractions, but I don't know the years of some of this stuff here. Average since 1950, number of quarters, contraction of a 10-year period. Okay, so this must be, each little block here must be like a different decade. And they're saying, so like the peak would be maybe 2014, 2024 would be maybe the less amount of contractions. It says 2 quarters. They're saying we're kind of, double what we were before. And you guys can pause these charts again. And these are the kind of stuff that's interesting to look at. So then the average is 5. Okay, so we're just a bit under the average. And again, this is the number of contractions of GDP over a 10-year period. Okay, so going back to the average, and that's that's a pretty safe estimate to say, hey, we're going to perform whatever average has been. What else it says here? The fourth headwind factored into Goldman's forward return model is corporate profitability. So how much money companies make. The firm tied its rationale in with a concentration argument above, saying that as sales and earnings growth decelerate, okay, so talking about, remember, a bunch of companies are, well, not a bunch, just a few companies are making up most of our earnings, so that's the Meg 7, and we're talking about, their profitability here. The firm tied its rationale in with the concentration of argument above, right, too concentrated, saying that as sales and earnings growth decelerate, so slow down for the market's biggest stocks, that will have an outsized impact on the entire market. Okay. So when Nvidia starts to slow down, you'll notice big changes in the market, and how soon that will happen. So in my opinion, the AI stuff is a bubble, but I know other people say differently, because on YouTube it's just popular to bandwagon on whatever's the most popular thing, and then people want to watch that and think they're all going to get rich, etc. So yeah, so that. So I guess according to this, then just see what the top of the market's doing. You have a good sense of how. And this is actually, we go into their earnings reports. I think it's either this week or next week we're going to get a bunch of these. I think Tesla's coming out this week also. Tesla's not really one of the top stocks though anymore, but they were at a time. And so essentially, actually, a good point though is that Tesla's profitability went down 45% last quarter. So we'll see. Finally, the fifth is the relative level of 10-year treasury yield, right? So comparing stocks to bonds. The 10-year yield is yielding north of 4% as investors recalibrate their rate cut expectations following a series of strong economic data reports and amid persistently hot inflation. So this is sort of why we cover all this stuff. Here you're talking about where is the Fed going to put rates? How's the economy looking? Do we need to cut rates in order to, get things going again? I'll give you an example where China is, they're cutting the rates because they're worried about growth. So that's sort of why we track this stuff. Like, are we worried about growth? Does the Fed need to cut rates? Then what does that do to the bond market, et cetera? And if Goldman Sachs is saying, hey, 3% in the market, 4% in bonds, and people are like, well, I'm doing bonds, that's guaranteed. Now, one of the things though with the market, again, it is more volatile, and that's always what you're trading off is like, okay, am I, willing, and this is for any investing, am I willing to take a bigger risk, essentially more downside and potential of more upside? I know the dream is have zero downside and unlimited upside, but it just doesn't work that way. And if you guys, if you find something that is that way, where you have zero risk and unlimited upside, please let me know. I'd love to hear about it, but generally speaking, it's just the higher chance of upside, the higher chance of low side. So that's one of the things that you have to balance out in your portfolio that makes sense for you. Depends what your time, horizon is, that kind of thing. If you're younger, you can weather out the storms. If you're older and you get like a couple drawdowns, you're just like, oh my God, I need that money now. And again, it all depends on your situation. The one thing I will say is we have a great community. We had a comment come in today, or actually 19 hours ago. I want to read it to you. This is from Rob. Rob's a good dude. Rob says, what do you think the net worth of your audience is? And he's asking, what do I think? And then he says, 5 minutes into this video, a Tiffany & Company ad displayed for a $24,000 gold bracelet. That's just a little bit out of my price range. So I'll just say this, Rob, you're in good company on this channel. And if you're watching this, you're in good company, guys. I don't know the average net worth of everyone on the channel, but I can say that we have a great community of people who are willing to have these kind of discussions in intelligent and mature ways. And I say mature because our audience tends to be older. I just looked at the numbers just today. 81% of our audience is over the age of 35. And yes, I understand my channel is much smaller than other channels out there, but that's because YouTube tends to skew younger. But in my opinion, and I think it's the right one, if you're looking for a good conversation about money and in a reasonable way, hang out with older people. Kids in their 20s. I mean, guys, I was in my 20s. I remember, if you don't know, I'm 49, but I remember my years in my 20s. You don't know what you're doing with money. It's just what it is. You're out wasting it, spending time on drinking and all kinds of stuff. That's the average person. And someone literally just wrote in the comments that they were doing that. And, not in their 30s, they're trying to be a little bit more smarter. But honestly, the earlier you can be smarter with money, the better off your life will be. So I do appreciate your time, everyone. I want to hear your thoughts on this. What do you think about this S&P 500 prediction by Goldman Sachs? And I'll catch you all in the next video.